Now, with a surge in a certain type of car sale, more and more buyers finding big savings right now.
More people are buying used cars despite increasing prices.
Imagine waking up tomorrow and realizing the car in your driveway just lost more value overnight than the stock market did in a week. Across America, vehicles that once held strong value are collapsing into financial traps. The vehicles that once felt like safe investments are turning into ticking financial traps, with repossession waves, insurance nightmares, and depreciation cliffs about to crush unprepared owners. But here's the part nobody's telling you. While millions will get crushed, a small group of buyers are about to scoop up the deals of a lifetime. Let me start with Jordan, a cashier from Michigan who thought he was buying the truck of his dreams. Just last year, he dropped $59,000 on a brand new Ram 1500. Fast forward 12 months, he drives past the same dealership and sees the exact same truck, same trim, same year, listed for $42,000. That's $17,000 gone in 1 year. Not long ago, trucks like his were actually appreciating in value. But today, they're financial anchors, dragging owners into negative equity and trapping them in loans they can't escape. And here's the scary part. Jordan's story isn't rare. It's happening everywhere, and that's just the tip of the iceberg. For 3 straight years, the used car market wasn't just hot, it was boiling. Trucks that once sold for $40,000 were suddenly pushing $60,000, and even everyday sedans were gaining value just by sitting in your driveway. That surge was built on 3 shaky pillars: supply chain chaos that strangled new car production, rock-bottom interest rates that made overpriced loans look affordable, and rental fleets hoarding cars instead of selling them. But here's the problem. All 3 of those pillars are crumbling at the same time. Supply chains have recovered, interest rates have doubled, and rental giants are unloading vehicles by the tens of thousands. It's a perfect storm, and it's already driving prices off a cliff. And yet, that's not even the scariest part, because what's happening inside dealerships right now makes this collapse look tame. Here's something most car buyers don't realize. Dealerships don't actually own most of the vehicles sitting on their lots. They borrow the money to keep them there, a system called floor plan financing. Think of it like a massive credit card for cars. Now here's the kicker. Every single car on that lot is costing the dealer about $40 a day in interest. With 100 vehicles, that's nearly $4,000 every single day just to keep the lights on. When cars were flying off lots and prices were rising, it worked fine. But now, inventory is piling up, values are collapsing, and lenders are showing up with clipboards. They're issuing what's called a margin call, demanding dealers pay cash immediately to cover the gap between what they borrowed and what the cars are now worth. Many dealerships don't have that kind of cash, and when they can't pay, they hand over the keys, not to customers, but to the bank. It's already happening across the country, and it's triggering loan defaults, insurance complications, and entire dealerships shutting down. But the scary part is what comes next, because while dealers are bleeding money, repossessions are about to make this collapse very personal. Every single day in America, 15,000 to 18,000 cars are being repossessed, not per month, per day. That's 1 vehicle every 6 seconds. By the time you finish this video, hundreds of families will have lost their only way to get to work, school, or the grocery store. These aren't just numbers, they're real people. Like Jim in Alabama, who lost his office clerk job and couldn't keep up with a $600 Toyota Tundra payment. Or a single mom in Houston, forced to choose between her car payment and her rent. The bank got the keys, and she got stuck with nothing. And where do all these vehicles end up? At auction yards, where repossessed cars pile up by the thousands, flooding an already oversaturated market. This isn't just bad news for struggling families. It's the start of an auto loan crisis, with defaults climbing and banks scrambling to cover losses. But here's the twist. Repos are only the first wave, because when those 3 to 4 year leases from 2021 and 2022 all come due at once, the collapse is going to hit a whole new level. Remember all those flashy lease deals people signed back in 2021 and 2022? Well, those 3 to 4 year contracts are expiring right now, and banks are panicking. Why? Because the vehicles they expected to be worth $35,000 are only fetching around $17,000 at auction. That's almost 50% loss on every car, and someone's going to eat it. Spoiler alert, it won't be the banks. At the same time, rental car giants like Hertz, Enterprise, and Avis are dumping millions of vehicles they held onto during the pandemic. Back then, they clung to their fleets because replacements were impossible to find. But now, they're unloading inventory faster than Wall Street unloads a bad stock. And here's where it gets messy. When lease returns and rental sell-offs collide, it creates a depreciation cliff that wipes out resale values across the board. That shiny SUV in your driveway? It could lose more in the next year than it did in the last 3 combined. There's another dark secret flooding the market. Literally. In the past 2-3 years, hurricanes and flash floods have damaged hundreds of thousands of vehicles. Many were properly totaled, but Carfax estimates that more than 55,000 flood-damaged cars have been title washed and are now circulating with paperwork that looks squeaky clean. Here's the danger. On the outside, these cars look perfectly fine. Dealers dry them out, swap the carpet, spray some deodorizer, and roll them onto the lot. But inside? The electronics are corroding, mold is spreading through the air vents, and brake lines are slowly rotting away. For buyers, these aren't just hidden repair bills waiting to explode. They're insurance nightmares and potential safety hazards that can fail without warning at highway speeds. And the worst part? Many desperate dealers are willing to look the other way just to hit a price point. So yes, falling values are bad. But the growing pool of zombie cars disguised as safe transportation is even scarier. And believe it or not, that's not even the biggest financial trap waiting in this market. Here's a hidden punch most car owners aren't ready for. Even as vehicle prices collapse, insurance premiums are exploding. In some states, rates have jumped 40 to 60% in just the last year. That means you could soon be paying more to insure your car than it's losing in value. Take Linda, a teacher in Florida. She owns a 5-year-old Toyota Highlander worth about $22,000. Last year, her insurance cost $1,600 annually. Today, her renewal notice came back at $2,900. She's paying luxury car premiums on a mid-size family SUV. And here's the kicker. As values plummet, insurers aren't lowering premiums. They're raising them, citing repair inflation, rising claim costs, and safety technology that's expensive to replace. For owners already underwater on loans, this is the knockout punch. Negative equity plus ballooning insurance bills. In other words, even if you ride out the price crash, insurance could quietly drain your wallet dry. But believe it or not, this isn't the end of the bad news. Because while insurance bleeds you monthly, the real opportunity for buyers is hiding just around the corner. Industry analysts aren't sugarcoating this anymore. They're predicting a full-blown bloodbath in used car values, drops of 30 to 40% by the end of 2025. On a $30,000 vehicle, that's as much as $14,000 in lost value in just 1 year. And it won't stop with car owners. Up to 30% of dealerships could be forced to shut their doors, cutting off service centers, trade-in options, and even leaving some extended warranties worthless. Think about it. If the dealer that sold you that peace of mind warranty goes under, who's paying for your transmission repair? The ripple effects are enormous. Banks tightening lending, insurance companies recalculating risk, even local governments losing sales tax revenue. This isn't just a car problem anymore. It's an everything problem. And yet, as bad as this looks, wait until you hear what's happening with financing. Here's the cold reality. America runs on auto loans. Over 90% of new cars and nearly 65% of used cars are financed, not paid in cash. So when banks slam the brakes on lending, the whole market skids. And that's exactly what's happening. Minimum credit scores are climbing, down payment requirements have doubled, and interest rates that were once 3% are now pushing 8% or higher. Even buyers with spotless 790 credit scores are being hit with 25% down demands and loan offers that feel more like highway robbery than financing. This credit squeeze doesn't just hurt subprime borrowers. It's creeping up the ladder, shutting out prime buyers and shrinking the pool of people who can even qualify. That means fewer sales, more unsold cars, and even deeper price cuts. It's a vicious cycle, and it's tightening like a vice. But as bad as that sounds, there's one more trap that might be even nastier. Because when you try to trade in your car right now, the numbers will make your jaw drop. For decades, trading in your old car was the bridge to your next one. You'd hand over the keys, roll your equity into the deal, and drive away happy. But today, that bridge is collapsing. Take Robert, a retail salesperson from Chicago. He bought a Ford F-150 in 2022 for $45,000. Last month, he tried to trade it in, and the dealer offered just $31,000. The problem? He still owed $25,000. That left him with $6,000 in negative equity, money he didn't have but the bank expected. Rolling it into another loan would have pushed his payment to over $800 a month, completely unaffordable. And Robert isn't alone. Nearly 45% of Americans with auto loans are now underwater, owing more than their vehicles are worth. That means millions are stuck, unable to trade in, forced to swallow rollover loans, or worse, staring down bankruptcy. And here's where it gets even uglier. While drivers are sinking deeper into debt, automakers themselves are starting to panic. Automakers aren't just innocent bystanders in this collapse, they're both cause and casualty. Over the last 2 years, they've been cranking out high-margin trucks and SUVs like there was no tomorrow, flooding dealer lots with vehicles that simply aren't moving. Now, as used values plummet and new inventory stacks up, they're facing a brutal choice: slash production and lose economies of scale, or offer massive incentives that further crush resale values and anger recent buyers. And the electric vehicle dream? It's hitting a wall. After pouring billions into EV development, manufacturers are suddenly pulling back. With gas prices stabilizing and resale values for used EVs collapsing, especially luxury models, the math no longer adds up. Batteries that were supposed to last a decade are now a depreciation time bomb, wiping out resale values faster than any gas guzzler ever did. It's a mess, but for the smart, patient buyer, this chaos is about to create an opportunity of a lifetime. Not every vehicle is going to collapse at the same pace. Some will hold steady, while others will free fall like a rock. The hardest hit? Luxury SUVs and full-size trucks. Think Cadillac Escalade, GMC Sierra 1500, Ford F250 Limited, Chevrolet Silverado 2500, and more. These rigs combine sky-high MSRPs, lousy fuel economy, and terrifying repair costs. At auctions, some 2-year-old models are already selling for $40,000 to $60,000 less than they did new. Owners of these vehicles aren't just losing money, they're getting financially wrecked. Then you've got the middle ground, mid-size SUVs and trucks, the Toyota Grand Highlander, Ford Explorer, Honda Pilot, Chevy Colorado, Ford Ranger. They'll take a hit too, but not as brutal. Expect values to drop around 25 to 30%. Families still need these vehicles, which helps cushion the blow. And finally, the survivors: compact, fuel-efficient cars and hybrids, Toyota Camry, Honda Civic, Kia Niro, Toyota Prius. These are the cockroaches of the auto market, cheap to insure, cheap to run, and always in demand. Their depreciation will be much softer, maybe 15 to 18%. In other words, if you're downsizing now, you could save thousands in fuel, insurance, and lost value. But even this breakdown doesn't tell the whole story, because the crash won't hit every region equally, and it won't crash equally everywhere in the US. Here's a twist most people aren't expecting: the crash won't hit every corner of America the same way. Urban centers like New York, Los Angeles, and Chicago will feel it first and hardest. These cities are flooded with lease returns, rental cars, and dealer competition. Buyers there also have alternatives like ride-sharing and public transit, which means they can walk away and wait. That creates a brutal race to the bottom on prices. Rural areas, on the other hand, might look safer at first. Fewer dealerships, fewer alternatives, and longer commutes keep demand steady for a while. But analysts predict a 2 to 6 month delay before rural markets get slammed even harder, as local economies simply don't have the cushion to absorb the shock. And it's not just where you buy, it's who you are. If your credit score is strong, you're in the driver's seat. Dealers desperate to move inventory will bend over backwards for prime borrowers, offering discounted insurance packages, rate buydowns, even free extended warranties. But if your score is under 650, the doors are closing. Subprime buyers are already being locked out with 30% down requirements and double-digit APRs. So, depending on your zip code and your credit score, you could be walking into a bargain or a financial dead end. And that brings us to the big question. Who actually wins this game? This used car collapse isn't just about prices slipping a little. It's about a massive wealth transfer. Millions of everyday owners are about to watch their vehicles sink into negative equity. Dealerships will shutter, and banks will slam the brakes on lending until only the strongest buyers are left standing. But the shocker is this. The real winners aren't the ones chasing luxury SUVs or flashy new EVs. They're the cash buyers who can scoop up vehicles for pennies on the dollar, the patient buyers who wait until late 2025 or early 2026 when the market finally bottoms out, and the contrarians who buy overlooked sedans and hybrids while everyone else panics over trucks. So tell me in the comments, are you planning to buy in the next year, or will you wait for prices to fall further? And don't forget to hit subscribe and turn on notifications, because the next crash could make this one look small, and I'll be here to make sure you're ready when it hits. We've just broken down the crash that's already unfolding in the US used car market. But what most people don't realize is that this isn't just about prices falling. This is about a systemic reset in how Americans buy, finance, insure, and even think about owning vehicles. If you thought the collapse was scary, wait until you see what's happening behind the scenes, because the hidden forces shaping the next 24 months could decide whether you save thousands or lose everything. Let's start with a dirty little secret about warranties. For years, extended warranties and service contracts have been one of the biggest profit centers for dealerships. They'd sell you a shiny promise, peace of mind, for 5 to 7 years. But here's what they don't tell you. If your dealership goes under, many of those contracts become worthless. The provider may disappear, or they'll deny claims by pointing to fine print that most owners never read. I've already spoken to drivers who tried to get a $4,000 transmission repair covered, only to be told their dealer-backed warranty vanished the day that dealership shut its doors. It's the same trap as buying an airline gift card from an airline that goes bankrupt. You're left holding paper with no value. And with up to 30% of US dealers at risk of closing, the warranty you think protects you might already be a ticking time bomb. Now, let's talk about something that's going to blindside millions: insurance risk recalculations. You've probably seen your premium creep up. But what's really happening is more brutal. Insurers aren't just raising rates because of inflation. They're rewriting how they calculate vehicle risk. Cars that are expensive to repair, especially those loaded with high-tech sensors, advanced driver assist systems, or delicate EV batteries, are being flagged as higher risk, even if they're sitting in your driveway losing value. That means you could be paying luxury-level insurance on a vehicle worth half of what you still owe. And here's the kicker. Once insurers mark a model as high loss, every driver of that model pays the price, even the safe ones. Imagine owning a Tesla Model Y or a BMW X5, watching its resale value crater, while your premiums double at the same time. That's not ownership, that's financial quicksand. And while we're on EVs, let me pull back the curtain on something automakers won't tell you. EV battery depreciation is far worse than official numbers suggest. Sure, they advertise 8 or 10-year warranties, but what they don't mention is the real-world resale penalty. A 3-year-old EV, even with plenty of battery life left, can lose 40 to 50% of its value because buyers fear the future replacement cost, a bill that can run anywhere from $12,000 to $25,000. This fear alone is enough to destroy resale demand, which is why used EV prices are collapsing faster than gas-powered SUVs. The industry is desperately trying to hide this by offering rebates and trade-in guarantees, but those programs won't last forever. When they dry up, owners holding on to EVs will be staring at catastrophic losses. Now, here's a piece almost no one's talking about: auto loan securitization. Remember the 2008 housing crash? Wall Street had bundled risky mortgages into investment products, betting homeowners would keep paying. Today, banks are doing the same thing with car loans. They package thousands of loans together and sell them to investors. The problem? Many of those loans were written at inflated prices during the pandemic peak, often to subprime borrowers. Now those borrowers are defaulting, repossessions are spiking, and investors are starting to panic. If the bottom falls out of the auto loan-backed securities market, you could see credit standards tighten even further, pushing millions of buyers completely out of the market. It's not just a car crash anymore, it's a financial contagion with echoes of 2008. And then there's the silent threat of technology obsolescence. We've entered an era where cars are rolling computers, packed with software that ages faster than the hardware. A 5-year-old vehicle might still run fine mechanically, but outdated infotainment systems, unsupported navigation software, or discontinued driver assist features can kill resale value overnight. Think about it. Would you buy a smartphone from 2015 today, even if it's still turned on? That's how future buyers will view cars with obsolete tech. For older drivers, this is a nightmare scenario. You're maintaining your car perfectly, keeping up with oil changes and brake jobs, but its resale value still craters because its software belongs to another decade. Now let's zoom out to something bigger: local economies. Car sales don't just affect dealerships. They fuel tax revenues, local advertising, even employment at repair shops. When dealerships close, you don't just lose a place to buy cars. Entire communities lose jobs, governments lose sales tax revenue, and small towns lose one of their largest employers. And when those jobs vanish, the local demand for cars weakens even more, accelerating the downward spiral. This is why experts are quietly warning that the used car crash could drag certain regions of America into localized recessions. And here's a final twist to consider. Repossessions and lease returns don't just flood the market with cars, they also flood the market with data. Banks, insurers, and automakers now have more information than ever about who defaults, who pays late, and which cars fail early. That data is being used to adjust everything, from loan approvals to insurance premiums, in real time. It means your neighbor's repo could raise your insurance, and someone else's default on a similar model could make your loan terms worse. In other words, the pain doesn't stay contained, it spreads. So where does this leave us? The truth is that the car market is entering a once-in-a-generation reset. Extended warranties may vanish with the dealers who sold them. Insurance premiums could outpace the value of your car. Electric vehicles are staring at catastrophic depreciation thanks to battery costs. Wall Street is teetering on auto loan investments that look shakier by the day. And even if you take care of your vehicle, outdated software could still erase its value. It's a perfect storm, and unless you're one of the few who understands what's coming, you risk getting caught in the middle of it. But here's the silver lining. In every crash, wealth doesn't disappear, it transfers. The informed, the patient, and the strategic are the ones who come out ahead. The smart cash buyer who waits until 2026 could pick up a luxury SUV for half price. The cautious driver who downsizes to a hybrid now could dodge the worst of the depreciation. And the savvy investor who sees through the smoke could turn chaos into opportunity. Because at the end of the day, this isn't just about cars. It's about money, timing, and survival. And the question remains, when the dust settles, will you be the one left paying the bill or the one cashing in on the deal of a lifetime?